Hey there, Iggy the Investing Iguana here. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with a total of 410,000 reads. Today, we're diving into a hot topic in the Singapore investment world, Treasury Bills, or T-bills for short. With recent 6-month T-bills offering a whopping 3.75% return, you might be thinking, wow, that sounds too good to be true. Well, in this video, I'll break down exactly what T-bills are, how they work, and whether they're really as amazing as they seem. By the end, you'll have a clear understanding of whether T-bills deserve a spot in your investment portfolio. So grab a snack, settle in, and let's get started. Treasury bills, often referred to as T-bills, can be thought of as a type of short-term loan you provide to the Singapore government. When you purchase a T-bill, it's akin to giving an IOU to the government. This is a financial agreement where you, as the investor, lend a certain amount of money to the government. The duration of this loan is typically short, either 6 months or 1 year. During this period, the government utilizes the money you've lent for various public services and developmental projects. It's a way for the government to raise funds for its operations without resorting to long-term debt. In return for your loan, the government makes a commitment to pay you back the full amount you've lent once the T-bill reaches its maturity date. But that's not all. To make the deal more attractive for you as an investor, the government also pays a little extra on top of the original amount. This extra payment is known as interest. The interest is the government's way of saying thank you for lending them the money. It's a small percentage of the original amount you've lent, and it's your reward for helping the government fund its operations. So, when the T-bill matures, you get back more than what you initially invested, making T-bills a safe and profitable investment option. One of the fascinating aspects of investing in Treasury bills, or T-bills, is the unique way in which they are purchased and how the returns are realized. Unlike traditional investments where you pay the full amount up front, T-bills operate on a different principle. You don't pay the full face value when you buy a T-bill. Instead, you pay a discounted price. Let's illustrate this with an example. Suppose you want to buy a 6-month T-bill that has a face value of $1,000. Instead of paying the full $1,000 up front, you might only have to pay $980. This discounted price is one of the key features of T-bills that makes them an attractive investment option. Now, you might be wondering, what happens when the T-bill matures? Here's where it gets even more interesting. When the T-bill matures in 6 months, the government doesn't just pay you back the $980 you initially paid. Instead, they pay you the full face value of the T-bill, which in this case is $1,000. The difference between the discounted price you paid and the face value of the T-bill is your earnings from this investment. In our example, that would be $20. This $20 represents the interest you've earned on your investment over the 6-month period. In essence, the process of buying a T-bill at a discounted price and then receiving the full face value at maturity is how you earn interest on T-bills. It's a simple yet effective investment mechanism that not only ensures the safety of your principal amount, but also guarantees a return on your investment. The process of determining the interest rate, also known as the yield, on Treasury bills, T-bills, is quite fascinating. It's not a fixed rate that's set by the government or any financial institution. Instead, it's determined through an auction process. This auction process is a dynamic and competitive environment where various investors participate to buy these T-bills. There are 2 ways you can participate in this auction: through a competitive bid or a non-competitive bid. Each of these methods has its own unique characteristics and advantages. In a competitive bid, you, as an investor, have the freedom to specify the yield that you're willing to accept. This means you have control over the return you expect from your investment. However, it's important to note that there's a risk involved. If your specified yield is not competitive enough compared to the bids from other investors, you might not be successful in buying the T-bill. On the other hand, a non-competitive bid is a simpler and more straightforward approach. In this case, you don't have to specify a yield. Instead, you just state the amount you want to invest in the T-bill. The yield you receive is determined by the outcome of the auction process. You accept whatever the final yield turns out to be. What makes non-competitive bids interesting is that they are allocated first. This means that if you choose to bid non-competitively, you have a higher chance of successfully buying the T-bill. This makes non-competitive bids a good choice, especially if you're new to investing in T-bills and are still familiarizing yourself with the process. Treasury bills, commonly known as T-bills, are widely recognized as one of the safest investment options available. One of the primary reasons for this is that they are fully backed by the Singapore government. This backing is not just a verbal assurance, but is supported by the government's AAA credit rating, which is the highest possible rating. This rating is a testament to the government's financial stability and its commitment to honor its financial obligations. Therefore, the risk of not getting your money back when you invest in T-bills is extremely low, almost negligible. Now, when it comes to purchasing T-bills, there are several options at your disposal. You can buy T-bills using cash, which is the most straightforward method. However, the Singapore government also allows the use of Central Provident Fund (CPF) funds or Supplementary Retirement Scheme (SRS) funds for this purpose. This flexibility makes it easier for individuals to invest in T-bills, regardless of their financial situation. The minimum investment amount for T-bills is set at a very accessible level of just $1,000. This low entry point makes it possible for a wide range of investors, including those with limited funds, to invest in T-bills. If you wish to invest more, you can do so in multiples of $1,000. This means you can invest $2,000, $3,000, $4,000, and so on, depending on your financial capacity and investment goals. While there's no maximum limit on how much you can invest in T-bills, it's important to note that non-competitive bids are capped at 40% of the total issuance amount. This rule ensures a fair distribution of T-bills among all interested investors and prevents any single investor from monopolizing the market. One of the significant advantages of investing in Treasury bills, or T-bills, is the tax benefits they offer. Specifically, the interest earned on T-bills is tax-exempt for individuals in Singapore. This means that whatever returns you make from your investment in T-bills, you get to keep it all. The government doesn't take a cut in the form of taxes. This tax exemption can significantly enhance your net returns and make T-bills an even more attractive investment option. Now, let's delve into a comparison between T-bills and another popular investment option in Singapore, the Singapore Savings Bonds, or SSBs. While both T-bills and SSBs are backed by the Singapore government, ensuring their safety, there are several key differences between the two that investors should be aware of. Firstly, T-bills have shorter tenors of either 6 months or 1 year. This makes them a suitable choice for investors looking for short-term investment options. On the other hand, SSBs can be held for up to 10 years, making them a better fit for those looking for long-term investment opportunities. Secondly, the method of sale differs between the two. T-bills are sold via auctions, which allows the yield to be determined by market forces. In contrast, SSBs are sold at a fixed price, providing certainty to investors about the cost of their investment. Thirdly, the minimum investment amount for T-bills is $1,000, while for SSBs, it starts at just $500. This lower entry point makes SSBs more accessible to a wider range of investors, including those with limited funds. Fourthly, the interest payment schedules differ. T-bills pay interest only at maturity, meaning you receive your returns in a lump sum at the end of the investment period. In contrast, SSBs pay interest every 6 months, providing a regular income stream to investors. Lastly, T-bills can be traded on the secondary market, offering liquidity to investors who may need to cash out their investment before maturity. However, SSBs cannot be traded, meaning investors must hold them until maturity to receive the full returns. The choice between Treasury bills, T-bills, and Singapore Savings Bonds, SSBs, ultimately depends on your individual investment goals, financial situation, and timeline. Both are excellent investment options, but they cater to different needs and preferences. If you're looking for a short-term investment option where you can park your cash with virtually no risk, T-bills are an excellent choice. They offer a safe and reliable way to grow your wealth over a short period, typically 6 months or 1 year. The interest earned is tax-exempt, and the minimum investment is relatively low, making it accessible to many investors. Plus, the fact that T-bills can be traded on the secondary market adds a layer of liquidity that some investors might find appealing. On the other hand, if you're looking for a longer-term investment with the flexibility to redeem early without any penalty, SSBs might be more suitable. SSBs can be held for up to 10 years, offering a higher potential return for those willing to invest for a longer period. They also pay interest every 6 months, providing a regular income stream, which can be particularly appealing for those looking for a steady cash flow. Moreover, the minimum investment for SSBs is even lower than that of T-bills, making it an even more accessible option for investors. In conclusion, both T-bills and SSBs have their unique advantages and can be a valuable addition to your investment portfolio. The key is to understand your financial goals, risk tolerance, and investment timeline, and choose the option that best aligns with them. Remember, investing is not a one-size-fits-all approach, and what works best for one person might not necessarily be the best fit for another. It's always a good idea to do your research and, if necessary, consult with a financial advisor to make the most informed decision. All right, let's recap what we've learned today. T-bills are a low-risk, short-term investment backed by the Singapore government. They offer attractive yields, especially in the current market, and the interest earned is tax-exempt for individuals. However, they do have some limitations compared to other investments like Singapore savings bonds. So, are T-bills too good to be true? I'd say they're pretty darn good, but like any investment, they're not perfect for everyone. It's important to consider your own financial goals and risk tolerance before diving in. If you found this video helpful in understanding T-bills, give it a thumbs up and share it with your friends who might also be curious about this investment opportunity. And if you want to keep learning about personal finance and investing, be sure to subscribe to the Investing Iguana channel. I put out new videos every week, breaking down complex financial concepts into easy-to-understand insights. Thanks for watching, and remember, investing is a journey, and I'm here to help you navigate it with confidence. Until next time, Iggy out.